Joining us now to talk about the data that we're going to see today and the potential market reaction. Barry Knapp, the Napster. Wait a minute. That's taken, right? Or is it available? It's probably available. Napster?
Probably available now.
We can use that, Barry. Managing director and managing partner director of research at Ironsides Macroeconomics. Also always a nice view of. It's not Lion's Head, is it? It's just Vail Mountain. What is that behind you?
Well, that's Lion's Head you're looking
Lion's
at.
Head.
Yeah.
All right. There's some great mountains, obviously. You're worried about the inability of the market to digest longer-term paper from the Fed. That's why they got to stay short. What's it all indicating to you, Barry? Is that a negative?
Well, until the rates market's truly stabilized, it's hard to see how the equity market would be in a sustainable, recovery rally, end of the Fed, 95 type scenario. So, yeah, I think what the Treasury did 2 weeks ago that sparked the rally, along with the Fed meeting and then a weak payroll report, was really a Band-Aid. By increasing Treasury bill issuance, it actually looks like liquidity is starting to tighten. You watch that Fed RRP program dropping precipitously. They may find themselves having to either tweak or stop QT before too long. So liquidity will get tight. They increased issuance in the belly of the curve, so 2-year note to 7-year note coupons or notes. But the problem there is they need the banking system to participate and finance a lot of that part of the issuance. And the banking system's in no position to do that, in as much as the curve is still inverted. The Fed is still threatening to hike further until we can actually get visibility to Fed rate cuts. I don't think the banking system's in a position to really help the government finance themselves. So that whole Treasury market situation, to me, looks unstable until we start to get rate cuts. I think we're going to get them next year. I mean, I'm in the 100 basis points or full percent of cuts camp for 2024. But, we need to get over this. We might, go one more time before we can get to that point.
Yeah, you're not going to get help de-inverting from the long end anytime. Yeah, you might from the long end because you're not going to get it from the short end anytime soon. So yeah, that's what I'm thinking. So that just means that it's just tough to keep those to keep a lid on longer term rates, and I think that's the fear.
Yeah, that's my basic point, is that any rally in the Treasury market should be suspect unless it's led by 2-year notes, right? And so even this morning we got, the long end down a couple of basis points, but 2-year notes are unchanged. So it ultimately needs to be the Fed that starts to ease that pressure on the front end, that allows the banking system to participate in those auctions, and then we can get a sustainable rally. Well, so I'm not quite in the Tom Lee camp as a consequence of that.
Yeah, and what does it mean? So you were bullish on stocks for the first half of 2024. You're not as much? I mean, am I reading this right? You're going from a 9 to a 4? Is that what it sounds like? I mean, 4 is much lower than a 9.
I was very bullish at this time a year ago. I was bullish through the whole first half of the year. I thought as inflation was coming down, the path from what I thought was going to be 9 to 4 would be a really favorable backdrop for stocks. And then once inflation stalled out, we would have a tougher time. And we're right now in that position where the necessary condition for the Fed stopping the hiking process and starting to ease is disinflation, right? We need a 2/10 today on core would be great. That would be a good starting point. We could talk about the details of that if you'd like, but we need inflation to come down. But then the Fed has also created this sufficient condition, which is growth weakening enough so that inflation not only goes down, say, towards 3, but stays there. And they believe that growth needs to weaken. I disagree with that. I think when they push that hard, they damage the supply side of the economy. Housing's a great case in point, but still, that's where the Fed's at. And I was actually quite surprised after the last payroll report, which I thought was really weak when you look at the details, that we got this round of Fed speeches that sounded pretty hawkish. And so, to me, the Fed just seems determined to get the unemployment rate above 4 and much weaker consumption numbers. So in some ways, tomorrow's retail sales number might be more important than this morning's CPI report, assuming that we don't get a big upside surprise in CPI.
Wow. Okay. So you're not necessarily, that had nothing to do, you're talking inflation with those numbers. All right. So you're not necessarily bearish on stocks next year in the first half, are you? Or have you turned into a full-fledged bear?
No, I haven't actually written my outlook note. Unlike the rest of the street, I don't work on the street anymore. I'm not Barclays equity strategist. I tend to wait till December. I don't know why the rush is to get them out in November, but
you're like the Fed.
You're
you have no idea what's going to happen a month in advance.
Exactly.
You just that's what worries people about the Fed. That it's just sort of seat of the pants, isn't it, with the Fed?
That's right. I think chances are that the first part of the year will be a little bit difficult in as much as we have a huge amount of loans to roll, commercial, residential, or multifamily real estate. We've got a bunch of projects in the pipeline, a bunch of private equity related financing that needs to get done. So I think the market will struggle with refinancing that, say, through February, March, until the Fed pivots. Now, if I'm right and the Fed cuts in March, then from that point, it could get really bullish. Now, you don't have to necessarily wait till they cut, but we probably are going to put the markets under some pressure before we get there. So I'm writing my outlook note on the fly here with you, Joe. But, so
right.
I suspect the first couple months will be tough. And then from that point, we might be able to get in a more sustainable uptrend.